April 2020 made headlines across the continent. Singapore's once unshakable oil magnate, Hin Leong Trading, announced it could no longer meet its margin calls, revealing a hidden loss of more than $800 million that had been concealed for years. The shock reverberated through the corridors of global commodity markets, exposing how a single trader's hubris could tumble an empire built on the flow of black gold through Asia's arteries. Hin Leong, born in 1989 to a humble family in Kuala Lumpur, entered the oil world as a teenager, hauling diesel barrels on motorbikes for his father's small import business. By his early 20s, he had already mastered the intricacies of freight contracts, price differentials, and the razor-thin margins that define commodity trading. In 2010, at just 21, he launched Hin Leong Trading, a boutique firm that would soon become a powerhouse in the Southeast Asian oil market. His early success was fueled by aggressive buying of crude and refined products in Singapore's bustling futures market, leveraging cheap credit from regional banks eager to tap the booming demand for energy in China, India, and Indonesia. The rise was meteoric. By 2015, Hin Leong was moving over 200 million barrels a year, rivaling the multinational giants that had dominated the space for decades. His strategy was simple yet daring: buy crude when the price spread between Asia's spot market and the global benchmark widened, then sell refined products into the region's ever-growing demand. The firm's rapid expansion attracted the attention of sovereign wealth funds and private equity, which poured capital into its accounts, further inflating its trading capacity. In 2017, Hin Leong announced a $1.6 billion strategic growth fund, positioning itself as the go-to counterparty for refiners looking to hedge volatile Asian spreads. But beneath the glossy press releases, warning signs began to flicker. In late 2018, the global oil market entered a period of unprecedented volatility. The price war between Saudi Arabia and Russia sent Brent crude tumbling below $30 per barrel, while Asian spot prices lagged, creating a massive spread that many traders, including Hin Leong, attempted to exploit. The firm's balance sheets, however, started to show an unsettling pattern: a growing reliance on short-term financing to fund speculative positions. Instead of using physical inventory as collateral, Hin Leong leaned heavily on revolving credit facilities offered by Singaporean banks, which began to tighten after the 2016 financial reforms aimed at curbing excessive leverage in the commodity sector. Insiders whispered about ghost inventories, paper contracts that showed a healthier stockpile than actually existed. In early 2019, a senior analyst at a major Singapore bank flagged discrepancies between Hin Leong's reported holdings and the physical verification data supplied by port authorities. The analyst's report was buried under layers of internal memos, dismissed as normal market fluctuations by senior management who were eager to protect the firm's reputation. Yet the discrepancy lingered, a silent alarm that few chose to heed. The turning point arrived in early 2020, when the COVID-19 pandemic crippled global demand for oil. Travel bans and lockdowns caused demand to plunge by nearly 30% in the first quarter. Asian refiners slashed their runs, and the spread that had once been a gold mine turned into a death trap. Hin Leong's positions, heavily leveraged and largely unfunded by actual physical oil, began to bleed. Margin calls from counterparties escalated, demanding immediate cash to cover the widening gaps. The firm's cash reserves, already stretched thin by previous speculative bets, proved insufficient. On March 31, 2020, the Singapore exchange SGX issued a notice that Hin Leong had failed to meet its daily settlement obligations. The next day, the company announced a temporary suspension of trading and an urgent request for a $2 billion cash injection. Within hours, banks withdrew their credit lines, fearing exposure to a loss that, according to leaked internal documents, had ballooned to over $800 million. By April 2, the firm filed for bankruptcy protection, and its founder, Hin Leong, stepped down, his once glittering name now synonymous with corporate fraud. The collapse sent shockwaves through the region's financial ecosystem. Singapore's reputation as a safe haven for commodity trading was bruised, prompting regulators to launch a comprehensive review of credit practices in the oil market. The Monetary Authority of Singapore, MAS, tightened disclosure requirements, mandating real-time reporting of physical inventories and imposing stricter limits on leverage for commodity firms. Several banks faced fines for inadequate due diligence, and a handful of investors sued, alleging that they had been misled by falsified financial statements that painted a picture of profitability while the underlying losses festered. For the workers on the ground, the aftermath was stark. Hundreds of traders, analysts, and support staff were abruptly laid off, their livelihoods evaporating alongside the firm's assets. Small-scale suppliers who had relied on Hin Leong's steady demand for diesel and gasoline found themselves with unsold stock and unpaid invoices, forcing many to shutter operations. The ripple effect reached the shipping industry, where charterers reported sudden cancellations of cargo contracts, leading to idle vessels and a temporary dip in freight rates. Legal proceedings stretched on for years. In 2022, a Singapore court convicted Hin Leong and several senior executives of falsifying accounts and breaching fiduciary duties, sentencing the founder to a decade behind bars and ordering the restitution of assets worth over $1 billion. International investigations uncovered that some of the hidden losses had been funneled through offshore entities in the British Virgin Islands, complicating the recovery process. Subscribe to The Collapse for more stories like this.